When billionaires move their money, they leave clues. Insider trading filings, land purchases, and investment patterns, all public information that most people never look at. Today, we're going to analyze the actual data behind how ultra-wealthy investors diversify their portfolios, why they do it, and what everyday investors can learn from these strategies. This isn't about conspiracy theories. This is about understanding financial diversification at the highest level. Here's something most people don't realize. When you have significant wealth, your investment strategy changes completely. It's not about getting rich anymore. It's about staying rich and protecting what you have. According to public SEC filings, we can track exactly when corporate insiders buy and sell their company stock. In 2024, some companies saw billions in insider selling, with about 89% of companies experiencing more insider selling than buying. But before we jump to conclusions, let's understand why this happens and what it actually means. When executives receive stock options as part of their compensation, those options often have expiration dates. Many executives exercise options that are set to expire soon. This is planned diversification, not panic selling. Think about it. If 90% of your net worth is tied up in your company's stock, what's the first thing any financial advisor would tell you? Diversify. Here's what most people don't know. Executives typically follow prearranged plans called Rule 10b-5 of 1. These plans allow them to schedule stock sales months in advance while complying with insider trading regulations. The trades execute automatically, regardless of what the executive knows at that moment. Insider sales often stem from completely normal personal financial reasons. Maybe they're buying a house, funding their children's education, paying taxes on stock option exercises, or simply following basic financial advice. Don't put all your eggs in one basket. Yes, insider selling has increased, but we need context. When tech stocks have risen 80 to 100% in a year, it makes perfect sense for executives to take some profits. That's not a crisis signal. That's prudent portfolio management. If you bought Apple stock at $50 and it's now at $150, wouldn't you sell some to lock in gains? That's exactly what insiders are doing at a larger scale. One of the most discussed topics is farmland ownership by wealthy individuals. Let's look at the actual numbers. Bill Gates owns approximately 242,000 acres of farmland. That sounds like a lot, right? But America has 895 million acres of farmland. Gates owns less than 0.03% of it. That's 0.03 of 1%. During a Reddit AMA, Gates stated, "I have invested in these farms to make them more productive and create more jobs." There isn't some grand scheme involved. In fact, all these decisions are made by a professional investment team. Farmland is a classic diversification strategy for several legitimate reasons. First, stable returns. Agricultural land provides consistent income through leasing to farmers. Farmers pay rent year after year, regardless of stock market volatility. Second, inflation hedge. Food demand is constant. When inflation rises, food prices typically rise too, making farmland relatively inflation resistant. Third, portfolio diversification. Farmland prices don't move with the stock market. When stocks crash, farmland values tend to remain stable. Fourth, tangible asset. Unlike stocks, which are just digital entries, land is physical. You can't print more of it. Despite all the attention, Gates isn't even America's largest private landowner. The Emerson family owns over 2.4 million acres. Media magnate John Malone owns 2.2 million acres. Institutional investors like pension funds and university endowments have been investing in farmland for decades. It's a well-established asset class, not some secret scheme. High-value art has become an established alternative asset class. Here's why institutional investors include it in their portfolios. Low correlation. Art prices don't move in sync with stock markets. When stocks crash, art values often remain stable. Scarcity. Famous artworks are unique and limited. There's only one Mona Lisa, only so many Picassos. Wealth preservation. Blue chip art has historically maintained value across centuries, surviving wars, recessions, and currency collapses. Art freeports are secure, high-tech storage facilities where valuable items can be stored while in transit between countries. This allows collectors to defer customs duties and taxes until the art actually enters a specific country for display or sale. While this sounds mysterious, it's a legitimate tax planning strategy used by museums, galleries, collectors, and investors worldwide. It's similar to how you don't pay sales tax on items you buy online until they are delivered to your state. Here's a practical problem most people never think about. In the United States, FDIC insurance only covers $250,000 per account. If you have $100 million, you can't just put it in a checking account at your local bank. Why? Because if that bank fails, like Silicon Valley Bank did in 2023, anything above that $250,000 limit is at risk. For a billionaire, or even a mid-sized company, leaving large amounts in a regular bank account is simply irresponsible. Treasury bills, or T-bills, these are short-term loans to the U.S. government, typically 1 to 3 months. They are considered the safest investment in the world because they are backed by the full faith and credit of the U.S. government. Money market funds currently hold over $6 trillion. That's a record high. These funds invest in T-bills and other ultra-safe short-term securities, providing liquidity with minimal risk. This isn't about fleeing the system. It's about smart cash management and ensuring funds are protected beyond standard FDIC insurance limits. Think of it this way. If you had $50 million in cash, would you leave it in a regular checking account earning 0.001% interest with only $250,000 insured? Or would you put it in T-bills earning 4 to 5% interest with the full backing of the U.S. government? Many countries offer residency programs to attract investment capital. This is standard international business practice, not some conspiracy. Dubai and Singapore offer favorable tax environments and political stability. They've become major financial hubs, attracting businesses and investors from around the world. European countries offer golden visa programs. Invest in real estate or businesses, and you can get residency, which eventually can lead to citizenship. Why do wealthy people get second residencies? The reasons are pretty straightforward. Business expansion into new markets. If you're doing business in Asia, having Singapore residency makes sense. Retirement planning options. Maybe you want to retire somewhere with better weather or healthcare. Family education opportunities. Perhaps you want your children to attend universities abroad. Estate planning across jurisdictions. If you have assets in multiple countries, proper legal structures are essential. This isn't about escape plans. It's about global mobility in an interconnected world. Millions of people live and work across borders. The wealthy just have more options. A family office is simply a private company that manages investments and affairs for a single wealthy family. Think of it as your own personal investment firm and financial planning team. When you have significant wealth, typically $100 million or more, you need specialized professionals, tax planning specialists to minimize tax liability legally, estate planning attorneys to structure inheritance properly, investment managers to handle diverse portfolios, philanthropy coordinators if you're donating to charities, risk management experts, sometimes even staff to manage properties, art collections, or family governance. Having all these professionals work together under one roof, coordinated specifically for your family, is more efficient than hiring them separately. Family offices reportedly manage over $6 trillion globally. But remember, this isn't shadow money or hidden wealth. These are legitimate wealth management structures used by families worldwide, operating within the law. Unlike public hedge funds, family offices have different reporting requirements because they manage private family wealth, not public investor money. This is similar to how your personal bank account isn't public information. You wouldn't want everyone knowing how much money you have and where you invest it, right? The same principle applies, just at a larger scale. The ultra-wealthy don't put all their money in one place. A typical portfolio might include 40% stocks and bonds, 30% real estate, 20% alternative investments like private equity or commodities, 10% cash reserves. You can apply this principle with any amount. Don't put all your savings in one stock or even one asset type. Here's an interesting pattern. As wealth grows, preservation becomes more important than growth. Someone with $10 million doesn't need to take huge risks to live comfortably. They need to protect what they have. This shift happens at every wealth level, not just billions. Even if you have $100,000 saved, protecting it becomes more important than gambling for higher returns. Wealthy individuals hire professionals because investment management is genuinely complex. But regular investors can access similar expertise. Low-cost index funds provide instant diversification. Robo-advisors offer automated portfolio management for minimal fees. Fee-only financial planners can create personalized strategies without commission conflicts. You don't need to be rich to get professional help. You just need to know where to look. Notice that billionaire strategies focus on 10 to 20-year horizons, not quick trades or get-rich-quick schemes. Warren Buffett's holding period for stocks? Quote, forever. This patience and long-term perspective is their real advantage. It's also the hardest part to copy because it requires discipline and emotional control. The investment strategies of the ultra-wealthy aren't mysterious or sinister. They're applications of fundamental financial principles at larger scale. Insider selling is completely normal. Executives diversify their stock compensation just like any financial advisor would recommend. Alternative assets like farmland and art serve legitimate portfolio diversification purposes that have been used for centuries. Cash management for large amounts requires institutional solutions beyond regular banking. That's just practical risk management. Geographic diversification is standard practice for international business in our globalized world. Family offices are private wealth management firms serving individual families, not secret organizations. You don't need billions to apply these principles. Diversify your portfolio across different asset classes. Don't put everything in tech stocks or crypto. Keep emergency cash in high-yield savings accounts or money market funds that currently pay 4 to 5% interest. Consider real estate if it fits your financial situation, maybe through REITs if you can't buy property directly. Think long-term instead of chasing short-term gains. Time in the market beats timing the market. Seek professional advice when needed. A few $100s for a financial planner can save you thousands in mistakes. Successful investing is about understanding risk, diversifying wisely, and staying disciplined over decades. Those principles work whether you have $10,000 or $10 billion. Public financial data is available for anyone to analyze. Stay informed, think critically, and make investment decisions based on your personal financial goals, not fear, hype, or speculation. Remember, the goal isn't to copy exactly what billionaires do. The goal is to understand the principles behind their decisions and apply those principles at your own scale. If you found this analysis valuable, consider subscribing for more evidence-based financial education. Thanks for watching.